Welcome to Stony Finance Lab channel.
Welcome to Stony Finance Lab YouTube channel. My name is Yongchen. Our topic today is home ownership and house mortgage. Let's begin with talking about 5 different types of mortgages. Before a home buyer begins searching for the right house, you will need to search for the right kind of mortgage to help make the purchase. The first type of loan is a conventional loan, which is best for borrowers with good credit scores. It is not backed by the federal government. The second type of loan is a jumbo loan. It's best for borrowers with good credit scores looking to buy an expensive home. The third type of loan is a government-insured loan, including the FHA loans, USDA loans, and VA loans. The fourth and fifth type of loans are fixed-rate mortgages and adjustable-rate mortgages. Conventional loans are not backed by the federal government. The two packages of conventional loans are conforming loans and non-conforming loans. Conforming loans conform to Federal Housing Finance Agency standards, including credit, depth, and loan size. Non-conforming loans don't meet Federal Housing Finance Agency standards. The advantage of conventional loans is that it can be used for primary, secondary, or investment properties. The borrowing costs are lower than other types of mortgage. Some disadvantages on conventional loans are higher credit score requirements, higher down payments, strict debt to income ratio, and also the requirement of many proof documents. Jumbo loans fall outside FHSFA limits. They are commonly used for expensive homes or higher cost areas such as Los Angeles, San Francisco, or New York City, where home prices may exceed the conforming loan limits. The pros of jumbo loans are being able to borrow more monies and competitive interest rate. The cons of jumbo loans are higher down payments, very high credit score requirements, and a debt to income ratio of lower than 45%. Borrowers must show significant assets in cash or savings accounts and usually need to go through more in-depth documentation checking to qualify. There are 3 types of government-insured loans: the Federal Housing Administration loans, U.S. Department of Agriculture loans, and the U.S. Department of Veterans Affairs loans. FH loans is backed by the Federal Housing Administration. These type of loans help borrowers that do not have large savings for down payments or good credit scores. The minimum credit scores to get FH loans is 580, and 3.5% of the down payment is required. USDA loans help moderate to low income borrowers help buy homes in rural areas. To qualify, the borrower must purchase a home in a USDA eligible area and meet certain income requirements. The last type of government insured loan is the VA loans. These type of loans are for members of the US military and their families. Some advantage of government-insured loans are more relaxed credit requirements and down payments. It will be helpful to borrowers that don't qualify for conventional loans. However, inventory can be limited because of loan limits. Borrowers will be required to live in the property and the overall borrowing cost could be high. Next, let's talk about a fixed rate mortgage. The interest rate stays the same over the life of the loans, meaning monthly mortgage payments always stays the same. It would be beneficial for those that want to precisely budget expenses every month. However, in the long term, borrowers are paying more interest. In comparison to an adjustable rate mortgage, interest rate of fixed rate mortgages are typically high. Adjustable rate mortgages have fluctuating interest rate that change with market condition. In the first few years of home ownership, the interest rate is lower and fixed. Therefore, it's possible to save a large amount of money on interest payments. As time goes, if interest rises, monthly payments could become high and unaffordable. Home values may fall in the future, making it hard to refinance or sell before the loan resets. An important part of a home buying or refinancing process is closing costs. There are a range of charges for service related to applying for a mortgage. These costs can amount to 2% to 5% of the mortgage balance. Therefore, it is critical to be financially prepared for this expense when purchasing a house. Closing costs are separated from the down payment and usually need a cashier's check to pay them. Closing costs depend on three key factors, such as home price, home location, and whether you are buying or refinancing the house. In general, closing costs can be separated into two parts. One is property-related fees, the other is mortgage-related fee. Fees like appraisal fee costs, home inspection costs, title search costs, title insurance, and prepared taxes are considered property-related fees. Mortgage-related fees include credit report fee, origination fee, application fee, underwriting fee, and points purchase fee. This is a simple timeline of the home buying process. Before searching for houses, the buyer should review his own finance and get a pre-approval letter from the bank. Then, select a good trustworthy agent to help smoothen the home searching process. If the buyer finds a house he likes, he can make offer and negotiate the price. If the seller agrees, then buyer should get home inspection and appraisals. After the loan is approved, buyers should schedule a final walkthrough before closing. At the day of closing, buyer pay for closing costs, sign paperwork, and get the house key. In this video, I'll talk about the 5 different types of mortgages. Anyone looking to buy a house should find out which type of loan to take before house searching. Keep in mind that closing costs should be budgeted as well. Thank you for watching this video.
Thank you for watching this video. Please feel free to like, comment, and subscribe to this YouTube channel.